look, if he can get the price of gold up a lot at $20,000 an ounce, if they can do things that make the market bid gold to 20,000, and people used to think that was insane, but I got to tell you, at $100 a day, it's looking less insane. 50 to $100 a day moves on the upside is looking a lot less insane than it was, say, 6 months ago. But if he can get it to $20,000 an ounce, which, by the way, would only put it back to 1989. Excuse me. It would only put it slightly above the long-term average of gold's price relative to the foreign portion of our debt. The market value of U.S. official gold relative to foreign debt. $20,000 an ounce would deposit roughly $5 trillion into the Treasury General account, free and clear. It's just straight money creation using gold. It's an accounting entry.
Luke Gromen explains that the global monetary system is undergoing a historic transition that most investors have not yet fully understood. He believes the sharp rise in gold, up more than $100 in a single day to above $4,100, is a sign of a deeper structural shift. China's decision to stop selling rare earths to Western defense systems represents a clear message. The geopolitical and monetary order that began after 1971 is breaking apart. According to Gromen, the milkshake theory is unfolding in real time. Both the dollar and gold are rising together, something that monetary theorists from the FOFO community predicted decades ago as the defining signal of the end of the dollar-based system. As dollar debts worldwide tighten liquidity, countries and institutions are being forced to sell U.S. assets to raise dollars. However, when gold prices climb high enough, they begin to serve as collateral against those dollar liabilities, providing the liquidity needed to escape the dollar's grip. In his view, gold becomes the exit valve from the dollar system. He notes that once gold passes critical thresholds around $3,000 and $5,000 per ounce, it starts to destabilize the dollar and treasury markets. The higher gold goes, the more it challenges the dollar's dominance as the primary global reserve asset. Gromen points out that, as of now, gold has overtaken U.S. treasuries in global central bank reserves, marking the true end of the post-1971 structure where treasuries were the world's core reserve asset. Still, he clarifies that the dollar itself will not disappear. People will continue using it as a medium of exchange for generations. But its purchasing power will erode, particularly in gold terms. Under Gresham's law, bad money, the dollar, will circulate while good money, gold, is hoarded. In short, the world has quietly entered a new era, one where gold, not treasuries, anchors the global financial system, and this transformation is likely irreversible.
I think still not fully digested. Might be being digested by the gold market this morning, which is up $110 as we speak, over $4,100 on the futures. But that's got a lot more to go, in my opinion, to properly digest that message. So I think it's really important in terms of what just transpired, because they're basically saying we're done selling rare earths into Western defense systems. Get your own rare earths. Milkshake theory is absolutely correct around initially gold going up with the dollar. Something I posted a long time ago on X, and people familiar with the FOFOA blog and the readings of monetary theorist another and friend of another will recall that in the late 1990s, another friend of another said that when the dollar system is coming to the end of its life, you will see the dollar and gold rise together. That will be the sign that the dollars, because people will be getting squeezed into the dollar at one hand, but they'll also be getting out and going into gold. And so when those two things are rising together, that's the symptom of the end of the dollar system. That was said 30 years ago, almost 25 years ago. And so, yes, the milkshake theory will see the dollar squeeze higher. I get it. And gold as well. And gold, once it hits critical tipping point of price, and I don't know where that price is, but you can see hints of it. Albert Marco on X has said, hey, above $3,000 on gold, it starts to create a problem for the dollar. He was right. The dollar went down to 96. It says above $5,000 on gold, it creates a problem for the dollar and for the treasury market. He's probably going to be right. And the point here, what he's saying when he says that is ultimately, yes, there is this, we've talked about this, $13 trillion dollar denominated liability out there, right? In terms of foreign borrowed dollar debt, that when the dollar goes up, it squeezes people into that. It forces them to sell treasuries. It forces them to sell U.S. equities to raise the dollars to get that. Well, once the price of gold gets high enough, it starts to fully collateralize their dollar liability on the other side. And suddenly it starts to provide the liquidity. It starts to be the sink. And that is how you circumvent the gold is how you get out of the dollar system. And that's why a friend of another said all those years ago, when you see them go up together, that means the dollar is coming to its end of life. This present form of this dollar system is coming to the end of life. Now, does it mean the dollar is going to die? No. I'll be using dollars, and your and my grandkids and great grandkids will still be using dollars. They're just going to buy us a lot less. And certainly in gold terms. De facto, we can see gold with today's price move has overtaken treasuries in global central bank reserves, right? So there's now more gold in global central bank reserves than there are U.S. treasuries. How do you sit there and argue and say, it's not overtaken the dollar in the system? To me, that's crazy. Now, will people still use dollars? Of course. Why? That's just Gresham's law, right? I hear people say, well, it's still dominant. 90% of currency usage, that's dollar dominance. Great. So you're spending, you're telling me it's the bad currency, right? I'll spend dollars all day long because there's a terrible store of value. But if the whole change of structure we've been talking about for years, and I mean, if you watch all my posts, all my podcasts, everything I've ever said, I've never said end of dollar reserve status. It's end of the post-71 structure of dollar reserve status, which is dollar as primary reserve currency, treasury bond as primary reserve asset. It happened. It's happened. The dollar is still primary reserve currency, but gold is now primary reserve asset as of probably this morning with the $100 move. And I don't think it's ever going back unless she suddenly decides to be, Yeltsin and, sell off his country for pennies on the dollar to American, corporate and Washington interests. And Putin decides to do the same thing because we can't go to war to stop him.
Luke Gromen explains that global power dynamics and monetary structures are shifting rapidly. Historically, any country challenging the U.S.-led monetary order faced military retaliation, as seen with Saddam Hussein and Muammar Gaddafi. China, aware of this, has strategically reduced its reliance on the U.S. by cutting off rare earth exports, effectively signaling a break from the old system and paving the way for a monetary reset led by BRICS nations. He argues that the continuous rise of gold reflects this transition, with prices climbing almost daily as a sign of systemic change. Trump's recent statements reveal that the U.S. no longer holds the same leverage it once did, highlighting America's growing dependence on external resources like rare earths. Gromen suggests that one potential U.S. response could be to revalue gold dramatically, up to $20,000 per ounce, which would create roughly $5 trillion in accounting gains for the Treasury. This move could lower the debt-to-GDP ratio and provide temporary relief, but would erode the purchasing power of dollar and stablecoin holders worldwide. He warns that time is limited, as interest costs keep rising and the window for such a reset is rapidly closing.
Yeah, I think that's exactly right. And historically, if you messed with the monetary side of the rules-based global order, the U.S. would send the military over and kick your head in. That's that had a big part of why Saddam was invaded, a big part of what Gaddafi was doing, as we know from Hillary's emails once upon a time. And the Chinese have been doing this. And so they've seen the message, which is when we try to change, which they have to, because again, they're not doing it because they hate us. They're doing it because they will literally have a late 1990s Southeast Asia crisis where China collapses like you saw Southeast Asia do, if they don't do this. And so they have understood the order of operations, which is if we're going to do this, we need to make it impossible for the U.S. to come over here and kick our heads in. And that's what this is about. And to me, the rare earth card being played in April or May, whenever that was, and we wrote about it at the time, is essentially we're done selling rare earths to the U.S. military. That was my interpretation of it then. This institutionalized it. This is basically, it's now in black and white. And if that's the case, then the window's wide open for the system to be reset. And I think sort of, number 1A on the list of symptoms that you would see as the system is reset in a manner that China, Russia, the BRICS would like is, I think you'll come in and you'll see the price of gold up on every day that ends in Y. And that's what we've been seeing over the last, month or so. Today, no exception. So, I think it's a huge deal. I do think that Trump with his tweets when he tweets impulsively or posts impulsively, he usually gives you something that he probably shouldn't either, or that that is incremental information. So last week, just some very serious people saying, "Hey, we're hearing Xi had a stroke. We're hearing Xi's being deposed." Well, Trump just told you that Xi had a bad day and made a mistake. So Xi didn't have a stroke and did not get deposed, per the President of the United States and his post. And then the other thing is we have heard chapter and verse from Trump, Bessent, Lutnick over and over about how we have all the leverage. That post just told us, no, we don't. Now, again, that's not a surprise per se, but that takes us from denial of the denial stage of grief about who actually has what level of relative leverage into somewhere between anger and bargaining, right? It's, he threw his fit, then he's like, well, it'll be, we don't want to put China in a depression and we don't want to put ourselves in a depression. That's exactly right. We'd put them both in a depression. So, let's de-escalate. But again, I think it masks like the number one key thing, which is we got to find our own rare earths for our own weapon systems. That's what the stablecoin gambit is. Now, what else can they do? Look, if he can get the price of gold up a lot, at $20,000 an ounce, if they can do things that make the market bid gold to 20,000, and people used to think that was insane, but I got to tell you, at $100 a day, it's looking less insane. 50 to $100 a day moves on the upside is looking a lot less insane than it was, say, 6 months ago. But if he can get it to $20,000 an ounce, which, by the way, would only put it back to 1989. It would only put it slightly above the long-term average of gold's price relative to the foreign portion of our debt. The market value of U.S. official gold relative to foreign debt. $20,000 an ounce would deposit roughly $5 trillion into the Treasury general account, free and clear. It's just straight money creation using gold. It's an accounting entry. Wouldn't have to sell any gold, whatever. And then you could buy down a pretty big chunk of debt. He can go out into the market and say, I'm going to, either he can finance the U.S., the long end needs with that $5 trillion for 5 years at least, probably more like 8 years, or he could just go in and immediately say, hey, I'm going to buy back $5 trillion worth of the $29 trillion out. That's going to take down 20% of the market. So debt to GDP is under 100 right away, assuming a money multiplier. Nominal GDP is probably going to run friggin' 15-20% for a couple of years. Debt to GDP will be back to 50-60% in a very short period of time over the backs of the purchasing power of stablecoin holders around the world. So they could do that, but boy, they got to hurry because Treasury, interest doesn't sleep.
Luke Gromen argues that the global financial and geopolitical order is undergoing a fundamental reset. China's decision to stop supplying rare earths to the U.S. military symbolizes the end of the post-1971 dollar-based system and the rise of a multipolar world led by BRICS nations. Gold's rapid climb, often alongside the dollar, signals the breakdown of the old structure where U.S. Treasuries were the world's main reserve asset. He explains that as gold prices rise, they begin to collateralize global dollar debt, allowing countries to move away from dependence on the dollar. Gromen believes gold has already overtaken treasuries as the primary reserve asset for central banks, marking a permanent shift toward a gold-anchored system. He also outlines how a dramatic gold revaluation to around $20,000 per ounce could provide the U.S. with a temporary fiscal lifeline by injecting trillions into the Treasury through accounting gains. However, this would come at the cost of devaluing the dollar and stablecoins globally. In his view, this transition is irreversible. The dollar will remain in use, but steadily lose purchasing power as gold regains its role at the center of global finance.